I'll have language in there stating that if the seller defaults willfully by selling the property to a third party in violation of the contract, that the buyer not only gets his deposit back, but that he gets reimbursed for his due diligence costs and maybe make it up to a certain capped amount. But that way you can at least make the buyer whole in situations like that. Um, there also are other mechanisms that can be employed if in your preliminary due diligence, if you have any concerns about the property as to whether maybe a certain tenant is going to renew, or there may be certain deferred maintenance items that are going to be costly. If you're able to, at the point where you're negotiating the contract, it's helpful to have certain escrow mechanisms um, as part of the contract, where basically either the seller has to complete that work prior to closing, or there'll be a post-closing escrow, where basically if the seller doesn't complete the work following closing, the buyer basically gets the money in escrowed remitted to it, and the seller is not able to take advantage of that.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Richard Crouch. Richard is a commercial real estate attorney and principal at the Virginia law firm Woods Rogers, where he chairs the business group. He's built his legal practice on the foundation of commercial real estate over the past 2 decades. And in just a minute, we're going to speak with Richard about contractual remedies. Get it right before things go sideways. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Richard Crouch. Welcome to CREPN Radio.
Thank you, Darren. Happy to be here.
Well, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. I've been practicing law for about 23 years, and I primarily focus in the area of commercial real estate. I do a lot of corporate structuring, but it's usually part of a real estate deal. And I've actually been with the same firm throughout my entire career. It's been a great place to work, and I was blessed with some very good mentors. The first of which was great about all the technical aspects, what to worry about, what you need to be afraid to miss when reviewing documents, title, etc. But the other mentor was better at mentoring all those aspects that they don't teach you in law school in terms of how to attract, retain, manage clients, how to communicate with clients, speak to them directly, answer their question, don't waste their time. If you don't know the answer to the question, let them know that you'll get them the answer quickly, but be honest and transparent with clients. And so that's been the background of my training, and pretty much in terms of areas of commercial real estate, if it touches on real estate, we handle it. So it's what you'd expect: acquisitions, dispositions, refis, historic tax credits, low income housing tax credits, qualified opportunity zones, and some of those more nuanced areas. But I'd say our bread and butter is working on private placements and any syndicators or promoters that are looking to raise equity and basically helping them navigate through those pitfalls to make sure everything is memorialized correctly with their investors. So that's in a nutshell my practice area and background.
Got it. So it sounds like the asset class, you're not, I mean, the people you work with, it's not required that they work in a particular asset class. Did I hear that right?
That's correct. Basically, particularly for syndications, I mean, every sector of real estate, we see that. When I started my career, there were quite a few retail syndications going on, but that phased out over time. They still happen, but not with the same volume and frequency. But we've done everything from office to self-storage to multifamily as well, and industrial as well. So really, it seems to touch on just about every asset class, other than single family. We tend not to see syndications in that arena as much, but pretty much every other sector we do.
Got it. And the entity structures, is there any kind of a sweet spot? I mean, you mentioned syndications a lot. I'm assuming those are LLCs with GPs and LPs, or is it
I would say 99% of the transactions are structured that way. Ever since limited liability companies became mainstream over 20 years ago, almost 30 years ago. People have liked the flexibility that they have. They have liked that a lot of the formalities are not quite as strict as what you see with corporations. They like the pass-through taxation aspect as well in terms of being taxed like a partnership. Um, and there's a lot you can accomplish with an LLC that might be a little bit more rigid under the corporate context, but that's typically the structure. And yes, usually there are LLCs within the LLC, but for our typical deal, usually there's a property owner LLC at the top of the structure, and that's where most of the investors are housed with respect to their membership interest, as well as the general partnership interest of the sponsor or the syndicator themselves.
got it? And even in that structure, I'm curious. I haven't really dove into it that deep, but with the GP and the LPs, is that's all in the same LLC? Is that correct? Or is that
That's that is typically the case if it's a
okay?
partnership. I would say the only exception we tend to see, well, I'd say there are a couple exceptions, but if you have a 1031 aspect going on, the regulations for that require that rather than being structured as a partnership, they have to be housed as what they call tenants in common. So the other investor who wants to avail himself to the whole tax deferral mechanisms in 1031s actually has to own the property in his own right or through his own entity. And it's kind of a quirky little nuance because people are so used to that syndicated partnership structure. To have a co-ownership structure is a little odd, but that is what the IRS requires. So that will be one of the only times that you might see two LLCs next to each other with one disregarded tax entity on one side and then the partnership entity that might have some of the other investors on the other side. So you may see that, or if you have a joint venture structure, you might have multiple entities involved. But even under some of the joint venture structures, you'll usually have them form an LLC, and then each joint venturer will have their own LLC that are members of that overarching LLC.
Got it. Yeah, that 1031 thing, I've kind of, I don't know, it's just an assumption that it's really not the easiest to do if unless everybody's going in as tenants in common. Is that am I right on that? Are you able to bring in one party as a tenant in common and then have the LLC that has the GP and the LPs
So you
next to it,
can
or is that
you can do it that way. Usually for our typical syndication model that we'd see, when they have entertained or accommodated doing a 1031 structure, it's usually been a pretty sizable investor who might be
right?
contributing 25% of the equity needed. And so usually the way they'll structure that is they'll have a traditional partnership structure for their LLC with the other 75% of the membership interests. And then sidecard to that, there will be this other LLC that'll be that large investor with his 25%. And it'll basically be set up that way, but you do have to have certain documents like a tenancy in common agreement and maybe an asset management agreement so that things flow smoothly. And you also maintain the structure that the IRS is going to require.
Hmm. And in that, would the partnership LLC then also be a tenant in common? And I mean, do
That's
both
right.
part? Okay.
That's exactly
So,
right. So, and what's kind of nice about that is, although that partnership LLC will also be a tenant in common, their particular operating agreement, and again, I'm going to say with the 75% of the interest, they on that side can still have their preferred return and their waterfall structure and their hierarchy of distributions that you don't normally have in a, I'll call it a tick structure. Um, so you can still handle basically the distributions with the non-tenant in common investors on that in that particular silo. And basically there'll be a separate operating agreement for the tenant in common investor.
got it. So, with your practice, are you primarily in the Virginia area, or are you able to work with syndicators nationwide, or what's your
Fortunately, yes. That's one thing that's insulated us a little bit in that we have clients do deals, particularly throughout the Southeast. Um, the way that we are able to accomplish that is, I mean, I myself am licensed in Virginia and North Carolina, and within our firm, we have 19 different jurisdictions represented. If for some reason it's somebody outside of our firm, we still have to collaborate with local attorneys for some of those state-specific nuances. And usually it might be relatively minor things, but just making sure that everything on the deed meets the statutory requirements. And oftentimes in interfacing with lenders and lender requirements, you have to get a state-specific opinion. So if somebody did a deal in Tennessee, we'd have to basically find Tennessee counsel who could opine as to certain things like the enforceability of loan documents and the qualification of the entity to do business for the lender's benefit, as really as for our clients' benefit too. They're going to want to make sure on a local level that everything's in compliance. But for about 90+% of a lot of the legal work or shepherding and guidance for our client, we're able to assist with that. But we definitely need to have a collaboration with local attorneys for something that's outside our jurisdictions for our firm.
got it? So let's talk a little bit about contracts and protecting yourself. Um, is is there a uh, I don't know, a typical or a roadmap when you're looking at like a syndicator on whether it be the raising capital side of things to the operations to the ownership, the contracts between the seller and the buyer. Are there some pretty standard ways of operating, or is each contract handcrafted for the unique issues all involved?
So every deal you can tailor it to your specific deal points. There are some principles that I try to incorporate into every deal when I can, and it's something I encourage, whether we call them promoters, sponsors, syndicators. I encourage them to make sure they get it right on the front end in every deal because it's easy to discount some of those, well, key terms because everybody's excited about the deal. Everybody's assuming that the deal is going to do well. And this is on both the syndicator side as well as the investor side. But it's very important to memorialize everything, to have an operating agreement that's going to cover corporate governance issues, that's going to cover how distributions are handled, um, and also to have private placement memoranda and subscription agreements that basically are going to have all the standard disclosures and disclaimers that are needed anytime you're handling securities. Because although these might not be publicly traded securities, they're still securities and they're still subject to certain regulations. Um, but the one bit of advice that I give to syndicators is always to be, particularly with the documentation, to be as transparent as possible. So if there are any fees, whether they be acquisition fees, dispositions fees, refinance fees, or maybe they have an affiliated property manager that's going to be getting a fee, to always have those very clearly disclosed in the investor materials so that there are no surprises later on, nothing that needs to be explained later on. And the other thing that I suggest, and this kind of goes outside the documents maybe a little bit, but if for some reason an asset is not performing as contemplated, in terms of transparency, the other thing I suggest that syndicators always do is have very open and frequent communication with their investors, because nothing is worse than letting something fester by playing ostrich and sticking your head in the sand. And nothing builds rapport and trust and credibility more than actively communicating with your investors. So some of the other things that in terms of documenting everything on the front end that I suggest is that there always be fairly clearly laid out exit strategies for investors. And sometimes this can be something where it's a very specifically contemplated date or event that basically talks about how investors are going to get their money back, how they're going to get caught up on any preferred returns that they were going to get, what the pro rata allocation is going to be, and how that basically happens either in capital events like a sale or a refinance, or just from operations, operational income from the property. What's the hierarchy of distributions, and when do investors, when they're actually ready to get out, whether it's like a 7 or 10-year hold, how is that all handled and distributed? Some of the other exit strategies that may be more circumstantial than specifically contemplated may be situations where the circumstances have changed in terms of the economics of the deal. I mean, people are seeing that right now with highly escalating interest rates and having numbers not work well because people were contemplating a much lower interest rate, or insurance costs and maintenance costs have gotten a lot higher. And so cash flow is a lot more limited. And so you may have some very dissatisfied investors, and it's really helpful in situations like that to have mechanisms where it's pretty clear how an investor gets out. And you do have events that weren't planned. You might have a death or a disability or a bankruptcy of an investor, but oftentimes it's going to be a situation where the investor simply wants to disassociate themselves from the firm, possibly because of poor performance of the property. And so some of the mechanisms that you'll commonly see in there is you'll have, I call it a buy-sell agreement um, or provision. Some people call it a shotgun clause that has a pretty clearly laid out mechanism or methodology for how the fair market value is going to be calculated for the membership interest and who's going to do that calculation. It'll also get into things like what type of notice do you have to give to the company and the other members? What type of restrictions are there on who you can sell your membership interest to? Because oftentimes companies and even other members to a certain extent are going to want to be able to retain control within, rather than have certain members be able to readily sell their interest to third parties that weren't part of the original investment. So that's something that you'll see as well. But oftentimes other members will have a right of first refusal to buy the membership interest of the exiting member, or the company might have a right to redeem it. So those are just things that you want to make sure are clearly laid out, because although there are certain default principles or statutory provisions in cases where maybe the operating agreement is silent as to how things should be handled, you usually don't want to have to rely on that. It's better to have express provisions, because with those express provisions comes certainty as to how things are going to be handled. So you have other things like call options and put options, where basically members can compel the company to buy their interests, or they can compel the syndicator to sell their interests to the other members. You see things like that, as well as tag along and drag along rights, which have similar principles involved in terms of being able to force minority investors to sell their interest, or have a minority investor be able to compel sale of the venture or their own ownership interests. Those are all a handful of mechanisms that you see in terms of sound and typical exit strategies that are helpful to have. Because again, everybody wants it to be sunshine and rainbows at the beginning of the deal, but you definitely need to have that roadmap for what to do when things go sideways. Now, that's mostly investors and syndicators. With respect to buyers and sellers, you do have circumstances now where there are certain contingencies that may be taking a while to get satisfied. There may be problems with financing in terms of getting the deal done. Um, Usually, when I represent purchasers, they are definitely going to be incurring a lot of expenses in terms of due diligence during their course of the transaction. And so the last thing they want the seller to do is to breach the contract and sell the property out from under them. Because simply getting their deposit back is not going to make them anywhere near whole. And you'll be amazed at the number of contracts I see where that's the sole remedy of the buyer. And if people aren't paying a close eye to that, the buyer might get his deposit of $10,000 or $100,000 back, but if he's incurred $50,000 in due diligence costs, he's still going to be at a loss with that. So when I'm representing the buyer on a typical purchase and sale agreement, I'll have language in there stating that if the seller defaults willfully by selling the property to a third party in violation of the contract, that the buyer not only gets his deposit back, but that he gets reimbursed for his due diligence costs and maybe make it up to a certain capped amount. But that way you can at least make the buyer whole in situations like that. Um, there also are other mechanisms that can be employed if in your preliminary due diligence, if you have any concerns about the property as to whether maybe a certain tenant is going to renew, or there may be certain deferred maintenance items that are going to be costly. If you're able to, at the point where you're negotiating the contract, it's helpful to have certain escrow mechanisms as part of the contract, where basically either the seller has to complete that work prior to closing, or there'll be a post-closing escrow, where basically if the seller doesn't complete the work following closing, the buyer basically gets the money in escrowed remitted to it, and the seller is not able to take advantage of that. I would say in terms of remedies from the seller's perspective, generally those tend to be more uniform from deal to deal. Sometimes you have situations where the seller might be able to recover more than simply the earnest money deposit if the buyer defaults, but I would say that tends to be the most typical remedy. And the reason you don't see a whole lot of remedies like specific performance in favor of the seller is because courts tend to not want to enforce that. It tends to be a little bit onerous on the buyer. Particularly if the buyer's, it's not an issue where the buyer's unwilling necessarily, but they're just completely unable to complete the transaction due to lack of financing or something else that's beyond the buyer's control. So usually forfeiting the earnest money deposit is going to be the main remedy for the seller. I think there are some ancillary remedies that are always good to have. For example, your buyer is going to be doing due diligence on the property. They may be doing an environmental or have an environmental report or have some invasive testing. And so you're definitely going to want to have obligations that the buyer restore the property to its condition if for some reason the property doesn't close, so that you're not stuck with those expenses, and have that be a remedy or an obligation that survives the termination of the contract as well, so that the buyer can't simply walk away from a project, leave it in disrepair, and have the seller basically stuck with those expenses. So those are some of the standard remedies that I see in the purchase and sale context.
Yeah, a couple of questions I've got. You were talking about that the remedy for the buyer, and if the seller cancels the contract, and that it's how to do it for more than just the earnest money. So are you, because I guess typically I've dealt with this and it's been more of the real estate broker contract, but do you get involved and review the contracts and insert language that's in the benefit of your client then, or do you represent the your client as the real estate representative?
We typically don't represent the brokers in the purchase and sale agreement context. We usually are representing either the buyer or the seller. I think if we were representing brokers, it usually would be in some scenario where they're trying to file a broker's lien because they haven't gotten paid on a deal that closed, or possibly
Sure.
a lease that got renewed. So that's usually the context we'd represent them, but usually our the scope of our service would be for the buyer or for the seller.
Right. So, but you do then review the purchase agreement before they sign it to insert this language. Is that what I?
We definitely do.
Okay.
In an ideal situation, we've reviewed the letter of intent as well. That oftentimes doesn't happen. Usually we have a signed LOI given to us for us to basically prepare the purchase and sale agreement after that. That's more the typical scenario, but the reason I like looking at the LOI is because when you're negotiating the purchase and sale agreement, one argument you always run up against is if you're trying to negotiate something that's not in the LOI, that's always the argument you hear from the other side as well. It wasn't important enough to be in the letter of intent, so it's not important enough to be in the purchase and sale agreement. So that's just one reason that it's nice to be able to look at the LOI, but we can still negotiate a pretty solid purchase and sale agreement, even if we're not involved at that LOI stage.
Got it. No, that's helpful there to know that. And then what was the other one you were talking about? Due diligence. Um, oh, in the escrow conversation. Um, I've had it happen, and it just befuddles me because I've got the numbers that I'm working on that I presented to the bank, and inevitably the uh, the settlement comes, and whatever deposits that were held by the seller get credited against the purchase price and lowers the loan amount as opposed. And I'm going, wait. Those were not part of the deal. Those are supposed to. I mean, those aren't our that that those are
Right.
the tenants' deposits. And I was like, how did that happen? Is that? And again, I've only done a couple of these deals, but it's always been like, you got to be kidding me. Kind
Yeah.
of.
So that I would say there are a couple ways to possibly skin that cat. I mean, one could be just an early conversation with the lender or mortgage broker, just saying, look, if I get credit for these security deposits on the settlement statement, I don't want that to adversely affect the available loan dollars. Can we agree to that? Can we have our term sheet agree to that? And hopefully that's something that can be negotiated. You could also agree in your purchase and sale agreement. Um, it's a little bit outside of the box to do this, but basically acknowledge that any transfer of security deposits will be outside closing. That's not improper. That's not illegal. That might be not the norm or the standard, but that would be one way to keep it from adversely affecting your available loan dollars. Um,
Well, or I was just kind of curious, is there a way would escrow not be a proper remedy for that? Say that these, these are outside of the deal. These go over here because they have to be maintained for the benefit of the tenants.
yeah, yeah, I could see that, and you could denote it on the settlement statement in such a way to basically clearly say this should not impact the purchase price. It's not really for that purpose, and in that same vein, it shouldn't impact the loan dollars. But no, I think I actually like the idea of the escrow mechanism. That'd be another way to possibly deal with that issue.
Got it. Got it. So let me ask you. So the you brought up a lot of good points on communication and that and exits and the idea with all of these documents is fingers crossed you don't have to use them. But when things happen, this is the map to resolve whatever the dispute is. Um, is there a single point or a primary point of where you see lawsuits or friction or the need to turn and use the document for operating, you know, to resolve a matter?
Yeah, and one thing I didn't mention, but is a good idea is usually you'll have a scenario where maybe a couple fiscal quarters have gone by and maybe a preferred return has not been paid to the investors, and then people will start to be somewhat up in arms about that and wondering about the future performance of the property and so on. And one thing that I also like to put in there, and it's not so much an exit strategy, but it's more of a remedy for investors, is to have a provision where so that you're not necessarily stuck with this manager or this syndicator, that you have a provision that they can be removed for cause if certain benchmarks have not been satisfied, like you haven't had preferred return paid for 2 fiscal quarters. The syndicator hasn't submitted a business plan as to how to turn the asset around, and then maybe have a majority or a supermajority vote to remove that manager and basically replace him with someone with whom you have more confidence. So it's good to have that, and that's when I see things that have are starting to materialize like that. That's probably one of those provisions is investor discontent. Um, Now, sometimes the syndicator and the asset are being impacted by things they truly cannot control. So you don't want it to be too arbitrary in terms of being able to replace them. And you want to give them a chance to perform, but you also don't want to have your hands completely tied at the end of the day. So that is one area that I'm starting to see a little bit of litigation. And I only think of a lot of those syndicators who, when things were humming along and interest rates were low, who were promising ridiculous returns to investors, and we're talking about doubling the rent immediately and all of these other things where it was much easier a handful of years ago. And now they're struggling, and some don't really have the experience to know how to get out of the issue they're currently in. Um, so that's an area where I'm starting to see things, and that if somebody's going to sue to try to recover their investment or try to enhance performance of a syndication, that's one area that I'm starting to see it.
Yeah. No, it's been asked of me, and I've looked into it, but I've not seen it. Directors and officers liability insurance. As an insurance broker, people have asked me about it, and I've not seen it put in place in a lot of the smaller syndications that I've seen. I don't know if you've seen or recommend, or if that's even an option that you've run across where, I mean, if there's fraud's not going to be covered, but if there's some sort of a mal, or some sort of a, um, there's an issue there where somebody, didn't perform. I'm just kind of curious, have you seen, or is that anything you've run into where syndicators or you know, um, deals have directors and officers insurance in place for these kinds of things?
It tends not to come up as often. I do think our clients tend to be covered because they may have some master policy that basically is linked to all of the various LLCs that they've set up across all of their projects. But it may be for coverage on one of those other entities that ties into the others. What I don't normally see is that coverage is necessarily specifically through the property owner LLC for a given deal. And that may just be because of the size of the deal and possibly the cost of the insurance. But I think they do have some supplemental coverage in most cases. One other area where you might see it is if you, for example, have a fund or a REIT that's in place that's acquiring properties rather than basically these one-off syndications. My guess is they probably do have more of that officer, director liability, managerial liability insurance that you'd expect. But I think for a lot of these one-off syndications for the LLC itself, the property owner LLC, I just don't tend to see it as often. But I do think under their master policy, they probably have some coverage.
Got it. Let me ask you, in the we are recording this in July of 2024, and I've it's been talked about for the last at least year or two based on the asset class of office having its struggles with kind of the reset that workers not necessarily going to the office like they did pre-COVID, and just the between that and inflation and the increase in borrowing rates, just there's a reset that's happening, which is affecting values. Um, and in that, I'm curious. We've talked about kind of the situation between the sponsor and the investors, and the exits and the potential issues that may come. But I'm kind of curious from a buyer's standpoint, somebody that's identified a property, has the numbers, and they're evaluating the opportunity, and looking for um, a deal in this market. Are there things in their due diligence that would potentially uh, point to or expose uh, pain that they may not have otherwise noticed in the documents? Their, whether it be um, their uh, PPMs, or whatever it is between the investor and the sponsors, that a buyer would see, that would identify they've got a problem, or maybe even in the lender docs. Is there anything
Yeah,
there that you can think of?
yeah. One of the most important documents, and you tend not to see it on the smaller multifamily deals, but you'll see it a lot in the commercial context. You might see it for an industrial deal or an office deal, or estoppel certificates. And I'll just give you an analogy. I mean, similar to yourself, I have side investments, multifamily, and so on, and but those are smaller ones. And oftentimes you'll get a rent roll where it appears to be fully leased and no delinquencies, and the numbers work. And then it seems like within 3 months, all of a sudden, it's 60% occupied. And so you realize that maybe the quality of the tenants were not that good. Now, unfortunately, in deals like that, you tend not to have tenant estoppel certificates like you do in the more sophisticated um, commercial deals. So tenant estoppel certificates, I think, are one of the most important things, because during your due diligence, you're going to be allowed to interview tenants, get a general feel for whether they're satisfied as a tenant, whether they intend to renew, but they're also going to sign an estoppel certificate that basically confirms what the rent amount is, where the security deposits are, and whether they deem there to be any defaults under the lease on the tenant's part or on the landlord's part. Because the last thing you want to do as a buyer is to basically be walking into or buying a lawsuit on day one. And so it's nice to basically have those certificates and make it very clear that the buyer is relying on that certificate and that the buyer's lender is relying on that certificate. And it just gives you a little bit more certainty that the rent roll you're getting is accurate, because that's basically what you're basing the future revenue on, as well as any returns and so on. And the last thing you want to have done is similar to what I was describing before, where all of a sudden 40% of your tenants are delinquent. And all of a sudden you have a problem with your lender in terms of meeting debt service coverage. You have a problem with your investors in terms of meeting their return. And it's very helpful to have those particular estoppel certificates in place. Some of the
And
other things, oh, go ahead.
I was just going to ask, the estoppel, is that basically you're communicating directly with the tenants to confirm what you've been led to believe?
Yes, yes. Oftentimes the buyer's counsel or the seller's counsel, it just depends what they agree to, will prepare those and send them to the tenants. And usually there's something in the underlying lease that requires the tenant to sign it with a certain number of days. So they can't hold it hostage. Like, within 10 or 10 business days, they have to return the signed estoppel, assuming it's all accurate. Um, so that's typically how that gets disseminated. Sometimes the seller will have it administered through their property manager, but once you receive those, they go to the buyer, and then the buyer shares it with the buyer's lender too, because the lender wants to look at things almost from the purchaser's perspective to make sure that their collateral is going to be sound and financially strong as well. So that's the general process for that.
Got it. You were about to say something else before I interrupted you.
Oh, yes. Some of the other aspects, I mean, if you look at loan documents, the level of sophistication and complexity is definitely going to depend on the type of lender um, you work with. So a lot of people will want to get non-recourse financing, and it's not uncommon that they'll go to the CMBS market for that. Usually those deals, at least in terms of legal fees, will cost a lot more because there's a lot more involved. Oftentimes you're having to form Delaware LLCs and get Delaware opinion letters and non-consolidation opinions. And usually the loan documents themselves are much more voluminous. I mean, your loan agreement could easily be 75 or 100 pages long, single spaced. And so there are a lot of things that you just need to be aware of because you're going to have a lot of provisions in those more complex loan documents that are going to require you to not only meet certain financial covenants, but to maintain certain reserves. And these reserves can be similar to what I was describing before. They could be deferred maintenance reserves. They could be reserves for a tenant that is a sizable tenant that they want to make sure actually renews its lease in, say, 18 months. Um, and you want to be able to make sure that you can still access those reserves to cover operating expenses for the property, so long as you yourself are not in default and you're meeting the financial covenants. The last thing you want to do is have the lender have complete sole discretion over these funds that you need to operate the property and to not have clear mechanisms for accessing those funds. So that's one of the most practical thing I see with some of these more complex loan documents. Um, but you also, and this I would say applies to all loan documents, even the most simple ones, is you'll have certain defaults on the part of the borrower that seem somewhat unfair and somewhat arbitrary. So you're generally going to want to have notice and cure provisions in favor of the borrower. So if they miss a payment, they have 10 days after they receive written notice from the lender to satisfy that monetary default. Or if they breach some other covenant that might not be financial in nature, that they have 30 days after they receive written notice from the lender to cure that default. Because the last thing you want there to be is some petty default and the lender is basically putting the pressure on and is on the precipice of foreclosing and on the property. And you don't want that to originate for something that could have been fairly easily cured. And one other thing that actually comes up more often than you would think, particularly with aging baby boomers that many of which have substantial financial wherewithal, is oftentimes they're the guarantors on these loans, even if they themselves aren't the key principal or the key sponsor. But a lot of loan documents will say that in the event of a death of a guarantor, that's an event of default. And talk about something that's beyond the borrower's control. And so usually you're going to want to have provisions that you can submit for the lender's reasonable approval, a substitute guarantor within 60 days after the death occurs. Um, so those are some other examples. And the one thing, if you're able to do it, is to impose some standard of reasonableness on the lender's discretion to declare a default. Because you'll also see provisions like if they feel like the collateral has been adversely and materially impaired. But there's not really much of a definition of what constitutes that. You want to at least be able to have some reasonableness standard imposed on the landlord, excuse me, on the lender when possible. Um, so those are most of the things I think of with loan documents. And then reviewing title is also important, and a lot of that is about minimizing surprises. So typically, if you're the purchaser on a transaction, you'll get a title commitment, and the title commitment will have a list of all instruments that have been recorded that affect the property. And that will reveal some important things like, is your property encroaching on an adjacent property? Is there an easement going through the middle of your building? Something that would be very problematic if the beneficiary of the easement or the instrument were to enforce those rights, because you might have to remove a portion of your building, which would be prohibitively expensive. Or you may have to basically restructure a building. You want to be able to avoid situations like that. At least get title insurance for it if you can. So it's very important to look into situations like that. And you also want to see if there might be some sort of property owners association, which is not uncommon in a commercial context, particularly for an office park or a setting like that, where you're required to either maintain something for the other beneficiaries or basically to pay into the association certain assessments. And if you don't, liens could arise from that. So if you have ongoing monetary obligations, you want to be well aware of that before you actually buy the property. And that's something else that can pop up during a title review. So there are many, many things from a due diligence perspective to look at, but those are a few of the gotchas to be mindful of.
Yeah, no, that's all very good insight on the potential pitfalls and what to look for. I appreciate that.
Certainly.
Hey, Richard, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there are three strategies we typically consider. We first look to see if we can avoid the risk. And when that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, the legal climate, the market climate, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Richard Crouch, what is the biggest risk?
I would say, and there are a few concepts within this, but I would say probably the biggest risk is not having the self-awareness to recognize your own limitations. And what I mean by that is there are a couple ways that this can play out. Certainly when transactional volume is humming along at a steady pace, commercial real estate attorneys are very busy. And this could probably apply to a number of professions. But sometimes the pace at which we must work, particularly with the mindset that time kills deals, and that's the mindset that we live by, but sometimes that pace can preclude extensive deliberation on important, sophisticated matters. And so I would say one of the ways to mitigate that risk is obviously you have to review every deal on a case by case basis. No two deals are exactly the same, but you do need to have certain um, preventative measures in place to basically back check yourself. Basically have certain things, whether they be templates, checklists, and so on, where on every deal, although some issues will leap out more than others, that you're basically looking at every single issue that could be an issue and disclosing that to the client. And if the instruments or the language of the deal address it, you tell the client how they address it. If they don't address it, you reveal that to them as well. And that's something that, from a practice management standpoint, definitely improves the consistency and the reliability of our product and our clients' ability to rely on that. Some of the other things in terms of just recognizing your own limitations is you're only one person and you can't do it all yourself. Sometimes it's a function of physical time. You can't do it. Sometimes it's an issue of being cost effective and using perhaps a less seasoned but more affordable attorney on your team to help you review certain documents or prepare certain documents. So that's a critical component as well, is basically being able to look at your team, surrounding yourself with people you trust. In fact, these may be people that in some aspect, they have strengths in area there that are stronger than your own. And being able to rely on them, uh, pinpoint their strengths, have them work well together so that you have some redundancy on deals that increase basically responsiveness, um, the maintains the quality of the deal, and keeps you cost effective as well. And also, and I guess the last thing in terms of how limitations can be a risk is not being able to delegate when you should. And I know this dovetails maybe with the prior principles, but it does basically limit your bandwidth and your ability to expand your own business and your own practice by not being able to trust those that you've trained around you and grown around you, to basically have the same skills that you've learned as well. So those are the general risks that I encounter, and those are some things that over almost two dozen years of practicing that we put in place to really mitigate those, at least as an attorney. Now, for our clients, I would say probably the biggest risk is similar to what I was saying before, is being too hasty to land the deal, get the deal, finish the deal without properly documenting what happens when things go wrong. I'd say that's probably the biggest issue. And sometimes we see this with less experienced syndicators, is they're so eager to get the deal. They haven't really thought through how they're going to get it financed or how they're going to raise the equity. And so oftentimes there's a bit of a scramble there. So that's another thing where, in terms of being prospective and forward looking, it's helpful to not lose sight of those more important things, because without the equity and without the financing, it's definitely very difficult to actually get the deal done. So there's some of the things that we basically highlight for our clients to be mindful of, and again, to just always be transparent and honest. And I say this quote often, that an honest man doesn't have to remember what he said, and I think that's very good. A very good tip for anybody who's particularly handling other people's money to live by.
No, well said. Good for anybody in business or in life, is just recognizing your limitations and knowing or learning and knowing how to work with others and delegate and all. That's good stuff.
Actually, I heard a fascinating analogy the other day, which it was describing basically shouldering the workload amongst oxen. And it was saying one ox can basically drag about 80% of its own weight. Whereas if you put two oxen and yoke them together, they can collectively transport 3 times their collective weight. And I think the same rationale applies to having a solid team, basically working to get a transaction done.
Oh, that's awesome. Richard Crouch, where can the listeners go if they'd like to learn more or connect with you?
Well, you can visit our website, which is www.woodsrogers.com. My email address is richard.crouch, and my last name is spelled like Crouching Tiger, at woodsrogers.com. And this may blow your mind, but I'm going to give my mobile phone number out, which is 757-353-0969.
Awesome. Well, Richard Crouch, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and I look forward to doing it again soon.
It was my pleasure. Thank you for having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.